Hello and welcome to our special series, London Eye. My guest today on the show is a veteran emerging market specialist. He used to be the CIO of Charlemagne Capital, which got bought over by Fiera of Canada just a couple of years back, and now he is the Chief Investment Officer of Fiera Capital. Julian, thank you very much for joining us on the show today.
Pleasure.
You've been an emerging market specialist for a long time, but till Fiera took over Charlemagne. As an EM specialist, how do you see things right now, given that there has been a little bit of consternation of late with the dollar regaining some strength? Do you see the second half of 2018 being strong for EMs?
That's a good question, because there's obviously a bit of uncertainty going on at the moment, as you said, surrounding the dollar and some of the external imbalances of some of the emerging markets. But I think overall the outlook is still relatively positive, because you've got positive earnings growth momentum, if you like, in emerging markets. You've had a growth recession really between 2011 and 2015 in the asset class. You've had 2 years of a recovery of that, but I think that the trend is still positive there. Corporate profit outlook is still good at the moment. You had a big spike in profits last year, again after a profits recession over the previous 4 or 5 years, and I think the outlook continues to be good double-digit growth across the asset class for this year and probably into next year as well. And secondly, and I think most pertinently relative to what's going on at the moment, is obviously what's in the currency markets, that you do have pockets of instability, I think, within the emerging market currencies. But for the bigger emerging market currencies, and I'm talking here about China, Korea, Taiwan, and India, which are obviously the 4 countries that make up 2/3 or so of the emerging markets benchmark, I think the currencies are in reasonably good shape. So I think overall the emerging market currencies are undervalued. What's happening at the moment is that the dollar is strong, but it's not as if you got dollar strength versus EM weakness in a polarized basis that you sometimes have across emerging markets. What you have at the moment is you've got dollar strength against all currencies, and against the euro as well. And almost the main driver of this is the relative performance of the US economy against the Eurozone economy, one of which seems to be accelerating, the other which seems to be slowing down a bit, and therefore possibility of rates increases in the US, and that's pulling the dollar up against the euro. And so in a sense, as an asset class, EM currencies are falling because of more for collateral damage reasons than for EM specific reasons, with of course 1 or 2 exceptions.
But do you see this current bout of strength in the dollar as a durable trend?
Well, we're not really dollar specialists, but the one observation I would make is that if you look at emerging markets over let's say a 30-year period or so, when you've had periods of dollar strength, or rather of US monetary tightening, which is not necessarily the same thing, the dollar often rises in advance of a spell of monetary tightening in the US, and this is very much what happened in the 2013, 2015, 2016 period, and then the dollar either treads water or even sells off after the rate hike increases. So I think it's really more a question of how much rates are going to go up in the States. And of course, the downside risk for EM and the upside risk for the dollar is that rates go up by more than the market thinks they're going to. But I don't see really any evidence of that happening. So as a non-dollar specialist, I would say the dollar doesn't necessarily look as if it's going to rise a lot further, certainly against emerging market currencies, which is an area we have a bit more expertise on, simply because I think emerging market currencies are supported by strong real interest rates and relatively strong fundamentals.
How difficult or easy do you find raising money for emerging market equities now? Because the flip side is that the US is doing very well as well, and that's always the big competing asset class. In the face of such strong performance in the US, is it easy to tell people that you can make a little bit more in emerging markets, give us some more money?
The short answer to that is no, it's not easy. The long answer is, though, that we've had 5 years up until 2016 a very strong outperformance of the US against emerging markets. I think the US market was up close to 50% over the 5 years. Before that, the EM was down by 25 or so percent. So you had massive bifurcation of performance, mainly justified by fundamentals because currencies are overvalued beforehand, because earnings growth has been much better in the US than in emerging markets, but that has changed a little bit, and so I think what's happened is that you've got some investors who are, in the short term they obviously don't want to be out of the dollar because it's going up at the moment, but in the long term they recognise that this, we've had this extended 5-year cycle. We're probably only 2 years into the reverse of that, and if you look over a 30-year or so period, you do have these extended cycles of emerging markets outperforming and underperforming the US and other developed markets. And so I think as emerging markets prove themselves to be more stable, then at the margin that'll encourage investors to put money into emerging markets at this stage.
But you do believe that, are you convinced that this is a 5-6 year kind of a sweet spot for emerging markets, a cycle in that sense?
Yeah, I do. As I said, we're already probably 2 years into it, but nonetheless, I think we're in a correction in that sort of overall 5-year cycle, because I do think you've got improving fundamentals and valuation differential between emerging and developed markets, or emerging markets, the US in particular, is still close to an all-time high. Yes, of course, you've got the one-time earnings boost in the US from the tax cuts, and you've got fiscal stimulation. And there's short-term boost to the US economy, which again I think encourages people into the dollar and into the asset class there. But I think overall you've got a better structural and sort of long-term outlook for emerging markets.
What about liquidity, though? Because as central banks begin to draw down, the process has started. How do you think emerging markets will cope with far reduced or far lower liquidity in the world?
I think in terms of international flows, there is definitely that's definitely an impact. So the reduction of the rate of increase, if you like, of liquidity into capital markets as a whole is clearly going to affect all the prices of all assets, whether it's US fixed income or global equities or emerging market equities or emerging market fixed income. So you do have to sort of paraphrase an economic expression, if you're looking between income effects and substitution effects. And the income effect is that definitely the pool of global liquidity is not growing at the same rate as it has been over the last 7 or 8 years in the whole sort of QE era. On the other hand, I think there's two things to bear in mind. Firstly, the liquidity from the domestic perspective isn't really being changed very much because these economies didn't have QE in the first place. There isn't the need to withdraw stimulation from these economies because they weren't being stimulated in the first place. And secondly, if you move on to the sort of substitution effect, what I think is happening is that there's a substitution argument away from fixed income into equity, because obviously growth is accelerating, and as growth accelerates you want to be where the growth is rather than in the fixed income component. And secondly, for the fundamental reasons that I said beforehand, the move from developed into emerging markets. And so I think these two things are slightly playing against each other, and in the short term the overall reduction of liquidity, or perceived reduction of liquidity, is what's winning. But I think over the medium term that should start to reassess itself in terms of flows into emerging markets. But I think within emerging markets, it augurs for taking money out of the fixed income market, i.e. out of EM debt and into EM equity.
The other thing which has happened this year is that crude has surprised people. It's gone to 75. People are talking about $80, $90 once again. Has that changed your view of your preferred destinations in emerging markets, or have you had to reallocate your portfolio in a sense?
Well, at the margin, yes, we have. So I think it's had a bit of an impact in terms of winners and losers. I think one of the biggest myths about emerging markets is the relationship with commodities in general and oil in particular, because people think, the oil price goes up, that must be good for emerging markets. But actually, if you think of it very simplistically, as I said earlier, the 4 countries I referred to earlier, Korea, China, Taiwan and India, the 4 biggest markets, 3/4 of the benchmark, all of them, of course, oil importers and commodity importers. So there's no way on earth they can benefit from from what's effectively a tax on manufacturing costs or consumption directly. And if you look at the number of emerging markets that are benefiting from higher oil prices, it's only really Russia and Colombia and the UAE and Qatar, which is 4 countries, but those 4 countries account for 5 or 6% of a benchmark. So the other 94% is obviously more important. In the middle, you've got countries which have previously been regarded as benefiting from higher oil prices. But again, someone like Mexico, for example, used to be a net oil exporter, now is an oil importer. Malaysia, Indonesia, Brazil, they're in the middle there somewhere. But even if you take those 4 medium-sized emerging markets out of the equation as well, you've still got 80+% of the asset class losing. So definitely, the rise in the oil price is a headwind. I think the causality, in a sense, of the relationship is actually the reverse. So in a sense, what's happening is that one of the reasons the oil price is rising is precisely because demand is increasing. So of course there's the politics and the supply side, and most commodity analysts will spend 90% of a discussion talking about the supply side and geopolitics and this, that, and the other. But actually, I think the demand side it may not be 50%, but it's certainly more than the 10% which people talk about. And I think that so in a sense, the rise in the oil price is a good thing because it reflects improved global demand. But of course, to the extent that there is a supply issue at the moment, and there clearly is, then at the margin that's negative for the asset class.
So in that light, I mean, we worry a lot about oil prices in India.
Yeah.
Does India become an underweight in your book in the emerging market universe?
No, I'd say it becomes at the margin possibly less of an overweight. I would say. I think the Indian market has struggled obviously recently relative to some of the other markets. Valuations still look reasonable, but it's definitely a headwind facing India at the moment. But again, that's partly a reflection of the fact that obviously the rupee's been relatively weak. And I think that's partly a reflection of the rise in the oil price.
At this point, a quick break. We're back in 2 minutes with Julian Mayo of Fiera Capital. Don't go away.